from our studio in New York City. I'm Julie Hyman, that's Josh Lipton, and this is Yahoo Finance Live. Here's what we're watching this afternoon. We're an hour away from the close on Wall Street, and investors are in a buying mood. Gains across the board with the S&P 500 hitting another record high.
And after the close, all eyes, of course, are on Disney, the entertainment giant, reporting earnings after the close, and streaming will be in focus, especially after that surprising announcement that it's teaming up with Warner Brothers Discovery and Fox for a new sports streaming platform.
Plus, Tesla sparking concerns that layoffs could be on the way. A new report saying the company is looking at which roles are, quote, critical. We'll have the details. Let's get you up to speed on the market action right now. We are taking a look at all of the major averages in the green. The Dow gaining about 187, about 0.5%. The S&P up 0.9%, as we said, touching a new record today. The Nasdaq up nearly 1% here and leading gains. We've got tech that is the best performing group today. It doesn't hurt that 6 of the so-called Magnificent 7 are also higher in today's session, with the exception of Apple, but Meta leading gains within that group, if you will. Energy is the only group, by the way, in the S&P 500 that's in the red today. We should also mention we're gearing up for a busy slate of earnings after the close, but led in particular by Disney and by PayPal. We're going to be bringing you those numbers when they do come out. But ahead of that, Disney shares a little bit off. We're going to talk more about its streaming deal as well throughout the program, the new sports streaming deal. PayPal also little changed ahead of its numbers, but ARM getting a little bit of a pop on anticipation of its numbers. We're going to talk about all that after the close of trading.
And you know what we're also going to talk about, Julie? I thought we'd start the show off.
Yes, let's
talk about banks. And one bank in particular, New York Community Bank Corp, NYCB, still in the news today. And we've kind of been swinging between gains and losses here. The latest headline that's interesting was actually impacting shares, was this new reporting from Bloomberg saying the bank is going to, sounds like, offload some of its mortgage risk. The bank gave an update, we know, also on deposits, which it said were up. It said liquidity ample. Of course, it's all coming after last week when the bank posted that surprising CRE loan losses, cut its dividend, stock tanked on that. And investors have been kind of wondering, trying to sniff out here, okay, what other regional banks might have similar exposure? Who else might we want to be concerned about? And you did see some other regional banks, by the way. They were down in today's trade. Yeah,
it's been interesting because there has been this discussion for the past year, ever since the last, bumpy road with the banks. Commercial real estate, where are we going to see exposure? Who's going to feel the pain from this? And so this is the first sort of big other concrete example of that we have seen in the public markets. And so, as you said, the company talking about trying to sell some of its mortgages off, but not just the mortgage risk, but also it has RV and marine loans, apparently, $1 billion portfolio that it is also trying to sell here. But the other sort of echo, if you will, of last spring is the bank coming out and saying, no, everything's fine. We are not seeing a flood of deposits go out the door, which really reminds us of what we heard from the likes of Silicon Valley Bank as well. And we know what happened in that case. That's not to say that NYCB is not going to make it, but just that there are some of these echoes from the situation that we saw before, and some concerns, not just with these regional banks about the commercial real estate exposure, but broadly, on big banks, larger bank balance sheets, where do we see it? On private credit firms, where do we see it? So I think there are still a lot of questions about where that risk could still be lurking.
Yeah, you're right to know that it is sort of that echo, because they come out and they were kind of taking these steps, try to sort of improve transparency and shore up confidence. I know some on the street we're still obviously cautious on that name. You have had officials clearly commenting as well. Yes. We heard Janet Yellen, and she was kind of just echoing what Jay Powell also said, which is, listen, and not speaking specifically about this bank, but about CRE, saying, we are concerned, it's on the radar, regulators are on it, and they're both kind of reading from the same page book there, that it's manageable in their words.
Yeah, definitely. All right, let's talk more about the latest on the regional banking turmoil and what is next for NYCB, as well as this broader concern. We want to bring in Dave Mazza, Roundhill Investments Chief Strategy Officer, here with us in studio. Dave, good to see you.
Good to see you as well.
So I note today that bank stocks, or at least financials broadly, are not down, right? It is, and NYCB itself is now rebounding. Yes. So how are you sort of thinking about that broader CRE risk, commercial real estate risk, and whether it is a larger problem?
Well, first and foremost, anytime you see another bank under pressure, it gets the hairs on your skin rising up, right? Because we've been through this drill before. Everyone goes back to '08 and what happened with the big banks, and it's not just one. And then we had almost a year ago today, banks that were generally considered to be high quality, well run, had strong exposures, going under. And here we are again almost a year later with a bank that acquired some of the assets of one of those banks under pressure. So it really gets you thinking, is commercial real estate gonna have this contagion risk? But what's interesting and been fascinating to me is people have talked about this concept of a rolling recession. I think CRE is a great example of that. It's just the marketplace kind of has been picking its spots and saying, we're going to go after this area, right? Tech was the first place, right? In crypto and the exposures that banks like Signature and Silicon Valley Bank had to that. But here, what's a bit more concerning to me about NYCB is the fact of all the multifamily loans that it has in the New York area, the largest market for multifamily loans, and what that could mean should the bank actually face further pressure.
So you used to be suggesting, Dave, if you're a viewer right now and you're invested in regional banks, you think there is reason for some concern here?
Certainly. I think some people have been trying to focus on buying the dip in regional banks, and there certainly could have been an opportunity. NYCB was actually one of the better known or well-liked banks because of their strong dividend. And many of the buyers turn into sellers, right? If they're not going to pay you that dividend, they're going to exit right away. What's interesting, though, is that to me, it's hard to say, like a wildfire, that this is not just a spark that's gonna go away. What the concern is, does this then flame into other areas? Ultimately, I think because of the stresses in the system and the lack of wanting for it to be real stress, something will happen here. The chairman, of course, the new chairman, I should say, moving from non-executive to executive.
At NYCB.
Exactly, to be clear there, could settle down the name. But what we've learned is once the short sellers and investors turn on these regional banks, they don't have a lot of patience. So that would be my concern for someone who's looking to invest in the space right now.
Okay, so let's talk beyond the space then, because if you're concerned about spillover, does that mean you as an investor stay away not just from regional banks, but from big banks? I mean, in the past situation last spring, the thinking was that big banks would actually benefit. I don't know if that's still the case with the commercial real estate exposure. Do you stay away from REITs, particularly multifamily and/or office REITs? Do you stay away from companies that offer credit to these, that are in that space? Like, how far does it go, and what do you watch?
Well, I think it's sort of an interesting point. Ultimately, probably a large bank will end up acquiring these assets. Now, that's not a prediction. I don't cover the stock from a fundamental perspective, but I think that's the scenario we're finding ourselves in, is that we cannot rely on having a bank, even a regional one, fail to a great extent, because we know the impact that has on real people, on depositors, of which have not been the issue in this particular case. But there is stresses. There's reports on a daily basis of large office buildings in areas like Los Angeles and other places that are selling for 50% less than they went at just a few years ago, or in some cases even lower than 50%. So it's hard to say that there's not issues with the real estate sector. REITs have been an area that I think many people have wanted to like for some time based off of the interest rate environment, but it's just not there yet. So even though rising rates in theory should help banks, this flat yield curve has done nothing but actually hurt them, and in fact has put pressure on things that are variable, like commercial loans. So the picture remains pretty murky.
Let me ask you this, just to switch gears a bit here too. Listen, earnings season rolls on, after the bell today, Disney, PayPal. Just interested to get your thoughts on what you make of earnings season so far. You've seen about 70%, I think, now of companies beat expectations. That is above the historical average, but what have been your big takeaways?
Yeah, earnings actually have been generally pretty good. I think investors are happy to see that we're out of the earnings recession and the slump that we saw there. But we're still in an environment, to me, that is these haves and have-nots. And that's something, a thesis that I've been talking about for some time, is that there's a select group of companies. Some of this is the Magnificent Seven, and there's others in other sectors that are winners. And then the have-nots are these losers. So for stock pickers or people looking to stay, let's take some risk and move back into areas that either had done well a few years ago. It's been challenged, and we're seeing that at earnings season. Look at the bivarication between Meta and Snap. You can choose really two companies in any sector and say who's done it right and who's done it well. And really what investors are focusing here is on that efficiency, right? It's kind of a sad thing to say, but companies that have embarked on layoffs are actually being rewarded by the market because it's improving their profit margins and the like. So to me, it's not clear that it's all clear on the earnings side, but we are seeing some companies really put up some strong numbers.
Yeah, although Snap is one that's cutting, and it's maybe the market thinks it's not cutting enough. Yeah. We've been sort of playing a fun parlor game that seems to be happening in the market right now, which is the Magnificent Seven still the Magnificent Seven, and what's the new FANG or Mag 7 or whatever you want to call it, or is it still just the Mag 7?
Yeah, it's interesting. So it was FANG, then FANG'em, and then more recently Magnificent Seven. Now we're hearing Sensational Six, or keeping
Dynamic Duo. I've heard that one. Yeah,
right. It's like now people are saying keep the Magnificent Seven because we kind of like it, and then maybe swap out Tesla. But what's fascinating to me is I actually went back and looked through time. Magnificent Seven as a term didn't exist in 2013, but I went back to Meta's IPO to measure this. And if you look at the divergence, the average range between the best performing and the worst performing name out of the Magnificent Seven, there are some years where it's over, on a rolling 12-month basis, over 1,000%. Now, some of that is Tesla's outsized gains, but also remember, Meta was in a huge slump for some time. There's been times where people have counted out Apple. So I'm not ready to give up at all on the Magnificent Seven, even including Tesla. Of course, time will tell. But these companies, on average, at least compared to the other 493, are showing high top-line revenue growth, high strong margin growth, and in a market has this uncertainty, whether it's from commercial real estate or other areas, that's where investors are saying, hey, it's not so bad where I want to sell stocks, but if I'm going to buy, I'm going to stick to the mega caps.
Yeah, they said a lot of these names too, Dave. Of course, part of the reason you've seen these stocks jumps is because they put so much time and effort and money into AI, integrating the tech across their portfolio, and you can see some of them, like Meta, really benefiting from that technology. And we have bulls on the show, so listen, this is the year you're really going to see use cases and monetization ramp. You buy that, and if so, what do you think are the smart ways to play that kind of broad secular theme?
Yeah, no, I would totally agree with that. That AI is actually here and now, right? A lot of times when it's thematic investing or other trends in the market, folks are looking at things that could happen 5, 10, 20 years in the future, but we're already seeing it, right? Companies like Salesforce and ServiceNow are integrating AI, which is often powered by cloud-based services from Microsoft and Alphabet and others to allow that to be more efficient for employees and for corporations. So as companies realize the benefits of AI, right, that's not just fun playing around ChatGPT, even though I like to use it myself, or other things of that nature, it can really be that co-pilot for employees to make them more productive. So to me, yeah, this remains the year of AI integration and the actual use cases. I think Microsoft's earnings were a good example of that. And even Meta, who's been plowing money into something like the metaverse, and there's questions about will that actually pay off? Well, those investments are starting to pay off in AI. Those are the enablers for a lot of this to happen.
Is that the dynamic duo, by the way, Meta and Microsoft?
I think the dynamic duo was referring to the two that had positive stock reactions after the prints. I think it was Amazon and Meta.
Okay.
Yeah, dynamic duo. Either way, it's catchy. I mean, it's fun.
All of the stuff is.
Oh, yeah. Dave, thank you so much for your time
Thanks
today. I
for
really
having me.
appreciate the insight. We move on. Let's get in on some trending tickers in today's trade. We're going to start off with, of course, Snap. Shares are plunging today. That's after missing on revenue, reporting slower user growth. So this one, listen, always Snap. We always seem to see big moves here either way, Julie. So Snap reported the stock was just in free fall. Few metrics that I just were worth mentioning. Lower than expected revenue. Revenue rose 5%, $1.36 billion. That was a miss. Full year growth flat. We know the company has been in cost cutting mode. You were just talking about that with layoffs. Even still, though, with that cost cutting, the company forecasting a loss in adjusted EBITDA way bigger than what the street was looking for.
Yeah, that seems to be the number that really was disappointing to folks. And looking at the analyst commentary, basically Snap has made a number of changes to its ad platform over the past few years to try to get back those ad dollars. Part of that the hit was a result of the changes to Apple's ad tracking, right? But Snap, according to these analysts, just have not made enough improvements, especially when you look at them in sharp contrast to a Meta or to an Amazon, according to analysts like Brian Nowak over at Morgan Stanley. So that seems to be sort of that there are fundamental concerns here about why the ad dollars aren't flowing to them and about demand for the company's products and for their ads.
Yeah, to your exact point, by the way, the team at MoffettNathanson was telling their clients this morning, ramping competition in AI-enabled product solutions at some of these bigger rivals these guys have to go against. Hard to see, they say, how Snap's competitive position and financial profile gets materially better, so they rate it a neutral. And to your point, what do they think are better plays? Meta, Alphabet.
Yeah, I mean, as you pointed out yesterday when we broke the earnings, the stock has gone up a lot over the last year.
It was a rocket ship.
So that's something to think about, too, as we look at the drop that we're seeing today. Let's also look at Uber. Those shares in focus after the rideshare company top fourth quarter earnings estimates. Gross bookings also rose by 22% year over year. A couple other numbers that stood out to me from Uber, I have to say. Active drivers. Remember, drivers were an issue for Uber, right? When there was a worker shortage overall. Active drivers up 30%. The number of trips that people took up 24%. And Uber won a big driver for them. That is their subscription platform, which, according to the company, drove 45% of their delivery gross bookings. In other words, coming from Uber One members.
Yeah, stock not responding too much in today's trade, but of course the expectations heading into this print were really high. I mean, the stock is still up more than 100% over the past 12 months. Meanwhile, rival Lyft, by the way, is down about 30% over that same period. You go through the analyst notes, it just seems like the street loved this report. I mean, they were very positive on it. They just thought it looked like the fundamentals here remain very strong. And by the way, some anticipating color on capital allocation during that investor day next week, something that could be another kind of upcoming catalyst.
Yeah, that was something that the company sort of hinted at as well, that it was going to be maybe giving some news on a share repurchase, some kind of capital return. Another one, by the way, where shares have done pretty darn well over the last year. They pretty much doubled.
For sure. Yeah. Finally, let's get a check on shares of Fubo here. Now, they are tanking today following that news that ESPN, Fox, and Warner Brothers have reached an agreement to team up and create a sports streaming platform. So FuboTV sliding in today's trade, Julie, and it's coming after ESPN, Fox, Warner Brothers Discovery. They announced, a new sports streaming service. Analysts at Cantor, by the way, saying optically and competitively, this is a negative development for Fubo, which of course prides itself on being that kind of place to stream live sports.
And exactly, and if there's this big competitor to it, I mean, cost, as we have been sort of bandying about in the newsroom today, is going to be important for this new offering. There have been several reports that put the price at around $40 or even more. So it occurs to me, I don't know how much Fubo costs, so I don't know how it would stack up.
Either way, though, I mean, you're right. There's a lot of questions. Who's going to run the service, the price? But if the price is any way competitive with Fubo, then that's why analysts who cover the name are saying, if it's competitive anyway, what does that mean for churn? What does that mean for marketing costs?
Yeah, exactly. By the way, the company reports earnings at the end of the month, so we'll be getting more information on how it's doing. Obviously, there won't be an impact from this yet, but one would imagine there would have to be some commentary and plans, to your last point, about whether they're going to have to spend more on marketing.
Yeah, that call just got a lot more interesting.
Yeah, definitely. Sure. All right, we're just getting started here on Yahoo Finance Live. Coming up, Disney is going to be reporting its latest earnings after the closing bell today. We'll break those numbers and see how the parks and streaming giant fared in the first quarter. Plus, the newest edition of our series, Goodbye or Goodbye. We're going to get analyst insight to break down 2 stocks and help you make the best choices for your portfolio. Stay tuned. We'll be right back. The S&P 500 testing the 5,000 level, but history suggests we might be in for a downturn ahead. Our chief chartist here, Jared Blickry, here with the details. What's going on, Jared?
Hey, Julie, I'd have to be crazy to talk about a downturn when we have the S&P 500 flirting with 5,000 and also making another record high. By the way, here is the 5,000 level. We came within 1 point. It was 0.11. So I do expect those hats to fly later today. No, I do not have one. But I'm looking at the possibility of at least sector rotation, and that's because we're seeing some divergences emerge. I've shown this chart. This is a Dow Transports versus a Dow Industrials. This is classic Dow theory, where we have in purple the industrials at record highs, but we have the transports here. They're struggling to get through prior resistance points. That's one divergence. And we can also take a look at the S&P 500 market cap versus equal weight. This goes back to the beginning of the pandemic, 2020, and this is a ratio. So if it's going up, that means the weighted part, the market weighted part, market cap weighted S&P 500, that is outperforming versus equal weighted, which is what you would think of as what we call the S&P 493. If you're a chartist, I'm seeing a giant cup and handle formation. So we could see more market dominance by some of these large players. But February is a time when historically we see a little bit of a pullback, especially in presidential years, the fourth year, the presidential year as this is. So I'm just saying this is an opportunity to look at potential sector rotation here. And for all the talk about the mega caps and the Mag 7, whether it's the Mag 7, Mag 6, or Mag 4, guess what's leading today? Well, that's the mega cap sectors right there, but we do have some other participants this year. You go down the line, third in place after communications and tech is healthcare, and then slightly underperforming the S&P 500, financials and industrials. Important to point out here, we have some technicals that favor long-term continuation for not only healthcare, but industrials and financials. This is a 3-year chart of healthcare. We just broke to the upside. Take a look at industrials. Those are at record highs as well. Just broke to the upside. Finally, take a look at financials. Not quite breaking the record highs, but they have broken through their 2022, 2023 resistance. So I'm saying look at financials, healthcare, and industrials on any pullbacks here.
Coming in strong with all the technicals you need to know. Jared, thank you so much. H&R Block reporting a beat on second quarter revenue while reaffirming its full year outlook. Shares falling in today's trade. This comes after the recent launch of its generative AI tax products using Microsoft's Azure service. Here to discuss this and more is H&R Block CEO Jeff Jones. Jeff, it is good to see you. Maybe we could just start with the report, Jeff. Just interested to hear what drove the quarter and what you see ahead, Jeff.
Hey, Josh, good to see you guys. So we did have a strong quarter. We're off to a really good start in the first half of the year, and we're really well positioned for tax season, really based on 3 drivers. Our core tax business, both consumer and small business, perform well. We saw really nice performance with our Emerald Advance product, which is a term loan, and we're seeing really good traction with Spruce, which is our challenger banking platform. So all in all, despite the market reaction today, we feel really good about the start of the year and our performance, over the last several years.
Hey, Jeff, I'm glad you acknowledged what's going on with the stock today, although it is up considerably off the lows of the session, still down about 4% right now. You guys did beat, as you pointed out. You did not raise your forecast for the full year. You reaffirmed it. Can you talk us through a little bit about why?
Absolutely. So much of our business is, linked to the tax season, as you know, and that is just getting started. And so while we feel very good about our prospect and where we're headed, it's just too soon to call that we're going to beat for the year when we're really just getting started in tax season, So, that's really why, but reaffirming, having confidence in what we're doing. We also announced the retirement of my partner and CFO, who will leave in September. There could be a little reaction to that news as well, but we're focused on overtime, not obviously one day or so after earnings.
And Jeff, I know it's early in the tax season, but on the call, were you all suggesting that maybe it was off to a somewhat slower start than you had imagined?
Well, we see the industry data, and we see the industry data just being a little slower start. but that raises no concerns for us about the year overall. And keep in mind, when you're in the first couple weeks of tax season, everybody is always eager to know how it's doing. And there's a lot of volatility as, consumers are paying attention, in this case, to child tax credit, or e-file opened 1 week later this year. So we see reasons why it could be off to a bit of a slow start, again, at the industry level, but it raises no concerns for us about the outlook for the full year, both industry growth and our performance.
And Jeff, I'm curious, there has been a free government or free IRS tax filing option for a while, but there's a new push, right, to have more people use it, a new site, et cetera. How much of a bite out of your business is that going to take, or do you guys not do much business on that sort of end anyway?
I think the important thing to remember, Julie, is today there are over 30 companies and organizations, not profits, that already offer free tax prep, including H&R Block. And so there isn't a problem in the market per se where consumers are looking for a place to go for free. And so, they're going to pilot this year. We have been very vocal in our opposition to that pilot. We're very supportive of the IRS in general getting more funding. We need them to be able to service the customer, process returns faster, answer calls better. So we absolutely want to see them get more funding, but we just don't see a problem in the market that requires them to offer free tax prep.
And Jeff, I want to ask you too about this line in the 10Q that I know got some attention, which seemed to suggest, I guess, Jeff, that maybe you all received a complaint of some kind from the FTC. Any kind of color or insight you can offer on that?
We always like to put in our disclosures, obviously, anytime we get an inquiry of any kind. And, this inquiry goes back to the Free File Alliance. And so we think it's prudent to provide that disclosure. That's why we added it in the document. But at this point, there's nothing more to share about, what's happening or what they're looking at.
Copy that. Jeff Jones, thanks so much for joining us. Good to see you.
Good to see you all. Thank you.
Is Apple finally planning to introduce a flip iPhone? According to a new report by The Information, Apple has at least 2 active prototypes of foldable phones. Yahoo Finance's Dan Howley joined us now with more. So active prototypes, what does that mean?
It means a few things. It means that they are interested in this kind of technology. It's something that other competitors have out there. We have Samsung and Google with flip phones right now. There's a bunch in China, and I think that's really where the kind of interest lies, especially for Apple. You're seeing more consumers in China pick up foldable phones. They're advanced. They have better capabilities. They're also pretty darn cool, right? I mean, I've used them a couple of times, and they're fun. So I think what Apple's trying to do here is kind of what Apple does, keep up with the Joneses as far as what's popular and then add its own spin on it, provide its own capabilities. The big thing here, though, is it's a prototype. It does not mean that one is coming. Apple, like every other company, develops prototypes and then shelves them forever. They go in that little, box from, Raiders of the Lost Ark, I think, and just sits in a warehouse somewhere forever. So it doesn't necessarily mean we're going to get one, but the prospect, it's looking a little more promising, though according to this report, it wouldn't happen anytime in the next, year or so.
And some people, they might be asking, what could they do with a flip phone that they couldn't do with this?
Right. So that's a good idea, a good question. The idea is that, this is a large phone, right? Where's my my iPhone? I have the 15 Pro Max, so it's a big boy, kind of chunky. The idea would be, okay, well, I don't want this, big screen, or I want a bigger screen than this. I can just fold it in half and then just drop it in my pocket, and there you go. With Samsung, they had the Z Flip and the Z Fold. The Z Flip, this right here is the Z Fold, where it kind of opens like a book. The Z Flip is one that opens like a clamshell. And so, the clamshell design, I'm gonna be honest, is awesome. Yeah. I love it. You can unfold it halfway and then let it sit on its own and prop itself up and then take selfies. It's also incredible to slap that thing shut when you're ending a phone call even if you're not mad at someone, just to be, feel like you're like
satisfying finality
yeah,
of ending the call.
Bam.
So, Dan, obviously you've had experience with it. For viewers who are not familiar, Dan went to South Korea, got to see how the flip phone was made, got to test it out. How is that thing selling for Samsung?
For Samsung, they're selling surprisingly well. They are more expensive than most phones, right? So the Z Fold is the most expensive. That's the Fold right there. The Flip is less expensive, around $1,000. I believe the Fold is $1,800 around there. So it's a spicy meatball, as I guess someone would say.
As you just did.
Yeah.
I have to say, I was on the train yesterday and I was watching a show on my regular size iPhone, and the guy next to me pulled out like an iPad or something, and I thought, that would be nice to watch something on a bigger screen, but I don't want to carry around the iPad.
And that's
There
the
you go.
exact
That's
point
it.
there. So I mean, you get the bigger screen, you get the better styling because it does look really nice, and there's more functionality to it. So I think if Apple can do it, they will. I just don't think they're going to release something that's frankly kind of bulky when it's folded up, like Samsung's devices.
Yeah, you can see it though. Higher price, meaty margins, China.
I mean, that's the big thing I think is for them is for China.
Yep, makes sense. Dan, thank you as always for joining us. Strong beard day, by the way.
Thank you, I appreciate
Really
that.
coming in
Keeping
strong.
it-
Yeah,
keeping it
very
nice
nicely
and
done.
tight.
Very nicely done. Coming up, the latest edition of our weekly series, Goodbye or Goodbye. We're gonna get analyst insight to break down 2 stocks and help you make the best choices for your portfolio. Stay tuned. More Yahoo Finance after this.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal is to help cut through that noise to navigate the best moves for your portfolio. And today we're taking a look at some tech growth stocks, which may have fallen off your radar as the Magnificent Seven has dominated the space and grabbed the headlines. We're looking at two of the less loved names in the market and highlighting which one could benefit from some key growth trends and one that might not. I'm here with Barron's reporter Jacob Sonnenschein. Jacob, thanks for being here.
Thanks for having me.
Good to see you. So let's get right to it. Your buy stock in this space is one that had some headlines earlier in the week, and that is on Semiconductor. And the stock's been sort of volatile over the past year or so, down, you could say, over the past 6 months. So let's get to your case here. They make chips for autos, among other things, and we're looking at a market that's improved, that's maybe has bottomed for the auto market.
Yeah, we need a cyclical recovery in automobiles. That's been hurting a lot of chip makers. It's been hurting Tesla, as we know. I can't sit here, and nobody can sit here and exactly call the bottom in the auto sector, but we're getting really, really bad volumes. Production for autos is going to be flat this year in 2024. Once we can get that cyclical recovery in autos, and I do think, by the way, interest rates are stabilizing, so that's great news for a sector like autos. Once that stabilizes, you're going to see revenue growth for on semiconductor, because I think our next point, right, is on electric vehicles.
Yeah, let's talk about electric vehicles, right? Because there, say if I have a gas powered or even a hybrid vehicle and I'm switching to an EV, as many people still are, even though there's some concern about waning demand, that needs a different kind of chip.
Yeah, and I don't know that much about the mechanics of automobiles or about the technology of chips, but I do know that the content per chip and just the amount of chip and power that needs to be in an EV is higher than that of traditional vehicles. So as on moves into EVs, it's getting that tailwind, and that is incremental revenue for on semiconductor. And so you could get mid-single digits total revenue growth for the company. They've got some mature market smartphones, but EVs will see mid-single digits revenue growth.
Gotcha. And then finally here, an expansion in gross margin. And we should mention, by the way, as we talk about onsemi, when I mentioned it had headlines early in the week, it was out with its earnings, and there were some concerns around its numbers, right? So, but you're looking at perhaps margins expanding here.
The earnings in Q3 and Q4 were not great, and the guidance has not been really good at all. The market has expected that. We came into Q4, which we got a few days ago, with onsemi trading about 15 times analyst consensus earnings estimates. The guidance in Q4 wasn't great. The stock still went up 5% because it was trading at 14 times. This is a company with gross margin expansion that could do double-digit EPS growth. It's got a lot of cash. It can do buybacks. So came into Q4 14 times. Now it's trading about 18 times PE when you look at the earnings that are going to be a little bit depressed this year. I still don't mind that. This stock could trade in the 20s, and the EPS growth is going to be there over the long term.
Gotcha. Okay, risk to the upside here could be if indeed autos don't, bottom out and then recover, maybe on the same timeline that you're potentially looking for.
Any bear on onsemi or any bear on this little group of stocks, onsemi, Texas Instruments, NXPI, that are exposed to autos, is going to say, we're just not at the bottom yet. But guess what? If you're picking stocks, if you're watching the show here and you want an idea, you got to go in and get something that's cheap and that has growth potential. So you have to take a chance on this.
Gotcha. And we should mention you don't own onsemi. You don't own any of the stocks we're talking about. But let's get to the one that you don't like. And this one is also, by the way, a newsy one, because it's going to be out with its earnings after the close of trading. We're talking about PayPal. A lot has gone on at PayPal over the last year, including, of course, a new CEO for the company, some new products, et cetera. But at the same time, you say it's been losing market share.
It's been losing market share. So the digital payments business, as we know, has been growing close to double digits. It's decelerating, but it's still growing. It's still displacing traditional ways of doing things. PayPal has been growing sales less than the industry, less than the business. It's been losing market share. You can clearly see in Apple services business, Apple Pay has been doing really well. My Apple digital wallet is really useful for me, especially at things like the airport. Google Pay, other things, has lost market share. One of the big issues, we're going to get there in a second, but I think we start with loss of market share. That's been really tough for PayPal.
Okay, so let's then get to slow growth, and this should be profit margin declines. Forgive us for the dropped word there, but just that it's not growing at the same rate as some of its peers as well.
And the big issue is that the loss of market share in specifically branded checkout is really bad, because newer segments that are less profitable, like Venmo and other smaller segments that PayPal has kind of sopped up, Those are faster growing than branded checkout, and they're also less profitable, lower margin. So now you have this mix of lower margin coming in, and so if you actually look at analyst estimates for gross margin next few years, it's going down from about 50 like a year or two ago to maybe 39% in the next few years. They might eke out, stable to slightly higher EPS growth over the next few years, but the gross margin issue is going to keep the multiple in the stock back.
Okay, and then the last thing also that we're looking at is they have come out with some new product announcements. In fact, notably recently, they had teased a big new product announcement. Then they came out with a bunch of stuff and the market said, that's it?
They made some product tweaks, they made some minor tweaks, and forgive me, I don't remember exactly what they were, but the stock didn't.
Which I guess says something.
Exactly, yeah, and one of the things that I was looking for, that I think a lot of analysts were looking for, was a digital wallet, like sort of what you can get on your iPhone, something that can kind of thoroughly compete with the new entrants into the market. They didn't announce that. The CEO was very kind of adamant in a recent interview on television, talking about tweaks the company's going to make, but they haven't made the type of tweak that's going to make them competitive again.
Okay, so the risk here to your downside case is if they did, come out with that, if he changes course and sort of introduce that kind of new product.
And that would send the stocks soaring, at least. I was talking with my boss, just a few days ago. It could cause a quick little pop in the stock because people would start to get more confident in market share, gross margins. The whole story flows into earnings and PE multiple expansion from there. My concern is to assume that would be speculative because I have not seen evidence of that.
Right. Well, we'll get more information on all of this after the close today when we get the earnings. So let's sum up what you're telling people here. Basically, you're telling investors people should consider buying on Semi. You believe it's an undervalued growth stock and that the auto market is recovering, paired with continued execution on long-term opportunities. On the other side, you're saying you might want to avoid PayPal, warning us to not look for more product innovation necessarily, or at least not in the very short term. And it is also seeing some losing market share. Thanks so much, Jacob Sonnenschein of Barron's. Really appreciate it. That does it for this edition of Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern. And we've got more Yahoo Finance coming your way after the break.
2023 marking the worst year on record for ESG funds. That's according to a new Morningstar report, as investors pulled $13 billion from U.S. sustainable funds. Our next guest, though, sees tailwinds for this style of investing, with increasing concern about climate change and corporate governance. For more, we're talking now to Hennessy Stance ESG ETF portfolio manager, Bill Davis. Bill, it is good to see you. And maybe we'll just start there with that headline, Bill, that ESG funds had their worst year on record, that investors pulled around $13 billion from these funds in 2023. Bill, I'm just interested to get your take on what do you think are the factors at play here, and what do you see for in 2024?
Yeah, Josh, it's good to see you again. I think, first of all, $13 billion is not actually a lot of money in the grand scheme of things. And I think some of that was kind of a natural repositioning. To be sure, ESG has faced some headwinds, I think, in 2023. However, I think that the underlying dynamics that are causing companies to more ambitiously decarbonize, focus on better governance, do all of the things that make them attractive from an ESG standpoint really aren't going anywhere. And in fact, I would say, if anything, institutional investors especially are stepping up their efforts to encourage companies to be more transparent and more ambitious. And I think, if anything, what's happening is the companies are simply using the term ESG less. But I think that the savvy ones understand that there's big opportunity in here, that there's opportunity to grab market share from competitors if they can develop new products and services that meet the demands of the market.
Bill, I think you hit upon something really interesting here, because obviously there has been a noisy backlash against ESG as an investing strategy. And so, as you said, maybe they're just not, people are not, or firms are not using the term ESG in the same way, or they're being more quiet about it. Is that what's going on? How is that sort of playing out?
Yeah, I think that's, Jill, I think that's exactly how it's playing out. I think you see investment firms that rightly so had, let's just call it, products that really weren't all that authentic, that have now backed away from referring to them as ESG products. And I think you've got large corporations, and you can look, you can do you can use a search term and just look for incidences of mentioning ESG, and you'll see that big companies are mentioning it less than they were a year or two ago. But that doesn't mean that that behind the scenes are not preparing for a future that could involve the SEC mandating what they need to disclose. And even before that happens, actively preparing for what's going on in California around two different bills that have passed, one of which requires companies that are doing more than $1 billion in revenue to disclose not only scope 1 and 2, but also scope 3. And then the other is to disclose physical transition risk. So nothing is really changing except for the fact that we're just being a little bit quieter about it.
Well, Bill, let me ask you, though, too, about kind of the role that politicians play here. You know, at least for some, Bill, as you well know, ESG has become it's become a punching bag. I mean, what kind of impact do you think that's having?
Like almost none. I mean, I think it's very difficult for everybody to kind of sift through all of the mixed messaging. But I think that, you know, the performative politics aspect of it seems to be changing to me. There's less, you know, this was like a campaign thing about 9 months ago on the campaign trail. It's no longer a campaign thing. People don't even bring it up anymore. And I also think it's worth noting that if you think about what ESG is at its core, all it really is a proxy for finding a well-managed company. And on balance, if you have a choice between investing in, say, 2 beverage companies, and one of them is being super thoughtful around its relationship to the most important resource that goes into its product, let's just say that's water, and the other one is ambivalent or oblivious to that, which of those 2 companies are you going to invest in? So I think, you know, at its heart, all of the hubbub about ESG is partly well-founded because there's a lot of product out there that really isn't particularly authentic. But a lot of it is just completely it's just all performative politics, and it has nothing to do with what's really happening.
So, Bill, let's get down to sort of nitty-gritty then, fundamentals as to what you're looking for criteria-wise when you're trying to figure out if a company does fit your ESG criteria. Especially as you say, are there more corporations that are paying attention to this right now? So do you have a sort of a bigger pool to draw from at this point?
Yeah, so Jill, we invest in the S&P 500. So in general, we are investing in the top half of every peer group that we can identify, and I think we've got about 66 of them right now within the S&P. And so with the exception of some categorical exclusions, for example, we do not invest in weapons, tobacco, or fossil fuels, and we never have. The reality is that really much, half of every industry group is available to us other than that. And so we have a pretty big pool. I mean, if you consider what I just said, that's probably a couple hundred companies out of 504 that we can invest in at any given point in time. I will tell you that the ESG behaviors don't really change that rapidly. Like, we're looking at data every quarter and we're getting real-time data feeds from other organizations more frequently. But the reality is that ESG scores don't change that dramatically from quarter to quarter. So it's more the fundamental things that we're also looking at. So in order to be in our portfolio, you need to be good from an ESG standpoint, or at least in the top half of your industry peer group. But you also need to be in the top 100 from the S&P as a whole around financial factors that we think are predictive of future performance over the upcoming quarter. So it's really, you got to be good at both to be included.
Makes sense. Bill Davis, thanks so much. Really appreciate it. Well, Tesla could be the latest company to slash its headcount in the new year. This is according to a report from Bloomberg. Yahoo Finance's Pras Subramanian is joining us now. And it's not saying that the company is coming out right and saying it's cutting people, right?
No, this is a possible email. I guess Bloomberg reporting an email went out to managers with a single line query if this employee's position was critical to each of their
that does seem like a pretty strong signal, if indeed.
Seems like they're asking about that. Pretty harsh if this leads to sort of dismissals there. But the company has some big costs, right? They have about $10 billion in capex coming up this year, $4.5 billion in R&D. They have 140,000 employees. And they warned about kind of a slow growth phase in their earnings for the next year because of this potential for a new car. So I think there is some possible worry there if you're an employee, but I don't know if it's going to be a huge layoff, or I don't know what they're pondering here, but it's possible that they might kind of trim a little bit.
It wouldn't be that surprising if they were trimming, though. I mean, when you really, look at not just Tesla, but the broader market with demand is slowing. Even with price cuts and margin impact, you wouldn't be shocked if you saw that headline drop.
Yeah, apparently they've raised headcount by 20% in the past year, so they're probably going to sort of right-size, I hate to use the word, but like where they might kind of like add positions, cut positions, maybe service, they need to add more for service, but maybe cut a little bit in sales, who knows, but we'll see what happens. And they're not, speaking of your last guest, they're not exactly an ESG firm either, so there's definitely some change going on.
Well, but or are they, right? They're an electric vehicle company, I don't know. Anyway,
I know.
What's also striking to me about this is that this is how traditional automakers tend to operate. In other words, they used to call it layoffs and you weren't fired because they would then be brought back when the demand came back. That's how traditional automakers have operated for a long time now, right? I mean, furloughing
workers based on changes in the plant. It sounds like this has to do more with the white collar. I believe it seems like they didn't mention the article. I think it has to do with that as opposed to the line workers. They're not exactly emailing the guys on the line saying, "Hey, is that tire fitter?"
Do you have to put that bolt on that car? Yeah, you probably do. Yeah, I guess that does make some sense. But it also reminds me of Musk's playbook at X, right? When he first took over that company, he was sort of relentless in saying who is necessary to actually keep the thing running. Yeah, it was brought up with X, like, are you with me or against me, right? Otherwise, just leave. You're going to work crazy hours or whatever term he used. Mm-hmm. Yes. I think that's part of what's happening. Beast mode, I guess.
All right, Pras, thank you. Appreciate that update. Meanwhile, we are just minutes away here from getting the latest earnings report from Disney. We're going to break down the numbers and see what the parks and streaming giant has to say about its battles with activist investors. We've got earnings, we've got the closing bell, we've got all your market coverage when Yahoo Finance returns.
There is the closing bell on Wall Street on this Wednesday. Let's do a quick check of the market, shall we, to see where things end up on the day. The S&P 500 up by 0.8% and hitting a new record once again today. We'll have to count up how many new records we've hit for the S&P this year. The Dow up by about 157 points, 0.4%. The Nasdaq leading the pack today, up by nearly 1% as we see a resurgence in the Magnificent Seven, I believe with the exception of Apple rising today. But tech shares rising on the day in terms of what was leading things. Consumer discretionary doing well on the day as well. So all of that pushing things higher.
All right, major averages in the green. Here's another name that was in the green, Roblox. Check out those shares popping. It's after delivering its first quarter of $1 billion in bookings. Company also saw average daily active users jump 22% from a year ago. Gaming company, the kids love it, Julie. We know that. Bottom line, Q4 bookings, they beat a record 71.5 million people logged in every day to play its games. And they monetize these players, by the way. Each player paid an average of $15.75 during the quarter to buy items and games. So that's, cosmetics, costumes, and that metric also beat expectations.
I'm shaking my head because some of those dollars float out of my household.
Do they?
Josh Lipton.
Yes. It's big in the
Do you know what
house?
the money is called on Roblox?
Give it to me.
Robux.
Makes sense.
Robux, my kids, That's what they wanted for Hanukkah this year.
Now, do they check with you what they're spending it on? Can I buy this battle axe, for example, or I don't know? No.
No,
they
once
just go.
once it has left me and gone to them,
That
the
makes
Robux
sense.
is theirs to spend how they please. I have not checked in with them lately to see which Roblox game they like the best, because you know there are lots and lots of different games on there. But what's interesting about the Roblox story as well is that there was this narrative for a while. There were questions around the sustainability of the appeal, right? The users were aging. Were they going to stick with Roblox? My kids have gone through several cycles of in and out of Roblox, which is interesting. I don't know if they're emblematic of what we're seeing more broadly, but it is interesting here. Something else that caught my eye, by the way, for Roblox, as we talk about this era of efficiency among tech companies, is that they have not done any big layoffs there, and in fact have said they're going to continue to hire. So that's something to consider.
Makes it a little different than some of those other players, for sure.
Yes, definitely. Let's talk about Anheuser-Busch. Anheuser-Busch InBev shares up after former President Trump says to give the Bud Light maker a second chance. The company is still recovering from the backlash over its partnership last year with transgender social media influencer Dylan Mulvaney. It is not that straightforward there, because he wrote this on Truth Social, by the way. But apparently, I guess there might be some connections business-wise between Trump and the company. It's unclear.
Yeah. By the way, Molson Coors in today's trade was actually under some pressure, I saw, because the team at Bernstein saying, relatedly, Coors market share gains over much of last year, driven by that kind of Bud Light controversy, now waning, they said.
Right.
So that was an interesting kind of dynamic to check out.
And Bud's going to come back to the Super Bowl and do an ad as well. What I was referring to, I should just give more details on that. There's a Republican operative named Jeff Miller who runs a government relations firm. Anheuser-Busch is on his client list, and reportedly he has been sort of working to get it back in the good graces across the political spectrum.
The plot thickens, so to
exactly.
speak. Finally, check out Sonos shares. They are surging after blowing past Wall Street expectations in the first quarter. Sonos also expecting improvement in margins and cash flow to continue in 2024. So stocks jumping, earnings beat, Q1 EPS 84 cents, Street was at 58, so easy beat. Revenue also better than expected, Julie. Sounds like an especially strong holiday season for these guys.
Yeah, definitely. That is part of it here. And it looks like analysts are still looking for more products from Sonos as well. There's some
big new ones maybe on the way
optimism around that.
Yeah,
There's some
that.
speculation around headphones or some kind of other category here. This is a Brian Sozzi favorite. He and I both have way too many Sonoses in our homes. And we've spoken to Patrick Spence, the CEO of the company, about it before and tried to get out of him what this new product category
The
is going
clues
to be.
do suggest headphones, to your point. That's what they're saying,
I don't know if I would be as much in the market for something like that, but again.
Some maybe will. Analysts, by the way, some at least thought their guidance was kind of conservative because they say that big product could be coming.
Yeah, well, we'll see.
Meanwhile, the Dow and S&P 500 closing at record highs. Jared Blickery here with a look at today's action. Jared.
Nasdaq 100 too. Records abound yet again. But the small caps not participating. We do see the Nasdaq Composite up almost 1%, the Dow lagging a bit, up about 0.4%. And just peering inside the market here, tech is number one, up 1.3%. It's the number one winner this year, followed by consumer discretionary. Now, consumer discretionary has been lagging. Amazon has been strong. It's the biggest in there, but Tesla has been weighing on it. And let's just check out the Nasdaq 100 and see where things fell. Tesla up 1.3%, Meta up over 3%, NVIDIA up nearly 3%, and Microsoft, record high, up 2%. And let me just show you our screen with the record highs on. Hadn't seen Microsoft in a little bit. NVIDIA there practically every day. Broadcom, a perennial favorite here, at least this year. Visa also in there. Costco, Merck, American Express. So a lot of recent entries just continuing their strength. And when we take a look at some of the leaders here, we do see a lot of pockets of strength rather than weakness. China, a sore spot once again. So was biotech and cannabis. But TAN, that's a solar ETF, up over 4%. Baito, that's crypto, that's Bitcoin specifically, up 2%. Then you got Korean stocks, home builders, etc. And I want to show you the disruption trade because this is a kind of one of those fringe areas of the market. We're seeing broad participation here. Roblox up 10%, Shopify up 4%. So all around, almost all around, seeing a lot of gains today.
Thanks a lot, Jared. Appreciate it. Well, we've got earnings coming out now from Disney, and a lot to go through here. So let's break it down for you as the shares rise 2.7%. The company's first quarter earnings per share beating estimates here, and the company sees its full year adjusted earnings per share at $4.60. That is above the $4.27 that analysts had been anticipating. This even as its fiscal first quarter Disney Plus subscribers missed estimates at 149.6 million. The estimate was for 151.2 million. Remember, Disney has been embarking on a password sharing crackdown, much like its competitor Netflix did. But Disney's saying, okay, we may not be growing the same rate with subscribers, but here's some money, shareholders. Disney boosting its cash dividend by 50% and doing a $3 billion buyback authorization. So those are sort of the big headlines here. ESPN Plus subscribers, by the way, also missing estimates, as did those Hulu and Live TV subscribers. So subscribers, it looks like across the board, shy of what analysts had been predicting.
Yeah, a few areas that we've been talking to analysts about this name all week, and a few analysts I know everyone wants to hear more color on the commentary. One, any color on ESPN's DTC strategy? We have those reports that Disney's been talking to the NFL about an equity stake. We've had people on the show, Julie, who said until you guys were on the sidelines, you said I'm not going to move to a buy until I get more color on what exactly is ahead there. Any color or updates on the company's cost savings initiatives too? Obviously, that's been in sharp focus for Bob Iger.
Yeah, most definitely. And I'm also looking in here to see what we heard from the parks, because that has been an area that has been of strength here. It looks like parks did beat estimates. I'm just looking in here for the numbers. We're going to check in with our Alexandra Canal in just a moment, and she's going to have much more on that front as well. I am seeing revenue from content sales and licensing down 38% year over year. Domestic TV network revenue down 14%. Some of that affected by what was going on with the strikes as well. So going to keep getting through here. It looks like experiences operating income, which includes the parks operating income, we have that number at $3.11 billion, which was ahead of estimates. Those shares building on the gains that we saw out of the gate. We're going to keep going through these numbers. And we've got more numbers also that we're going to bring you. Still to come, Disney higher on those first quarter numbers and the forecast. We'll take a deeper dive into the latest numbers from the parks and streaming giant on the other side. And PayPal earnings still to come. We'll break those numbers and speak to an analyst later in the hour. Keep it right here. More earnings for you. ARM Holdings shares soaring some 23% after that company reported its numbers. Now, ARM, a very important one to watch for the semiconductor industry. It's so-called semiconductor architecture that it provides. So works with many semiconductor makers and is a good measure of demand for that industry. The company raising its full year outlook here as it sort of expands beyond smartphones. Revenue in this current quarter is going to be $850 million to $900 million. Analysts were looking for $778 million. The earnings prediction also above estimates, and same goes for the full year of what ARM is predicting here, Josh.
Yeah, it's interesting because when you think ARM, you think smartphones. But when we've spoken to CEO Rene Haas, and we talked to him about that, and he said, listen, obviously, that's our bread and butter, that's what we're known for. But he also talked about looking ahead and their ambitions in markets beyond smartphones and server chips, for example. And you're seeing perhaps some of that play out too in these earnings.
Yeah, and remember, ARM is still controlled by SoftBank, but it just had that IPO last year that was closely watched. The IPO at $51 a share, and sort of initially, as we know, last year, at the end of last year, was a little bit rocky for the entrance into the market, including ARM. But since then, it's done pretty well. As you can see from the chart, now it's trading at 77 after that $51 IPO. So we have seen an increase in the shares, and we're going to be watching this one closely, and not just ARM itself, but let's keep an eye on the whole semiconductor industry to see if we see some follow-through and spillover from these ARM numbers, which are pretty extraordinarily high here, and you see that commensurate stock reaction. Speaking of some extraordinary stuff going on, Disney numbers are just out in the stock, jumping on the print. We're joined by our senior media reporter, Alexander Canal. Ali, we just did the numbers. So I'm actually going to start with another headline that caught our eye. The company is investing $1.5 billion in Epic Games, the maker of Fortnite. Then we'll back into the numbers. We were just excited about that one.
No, I think this is just another example of how Disney is trying to innovate itself and really protect itself when it comes to some of the problems that we're seeing at media at large, especially when you think about linear networks declining. I mean, linear networks did decline once again in the quarter, falling 12% year over year. That's an area that struggled on the advertising side. So they're trying to find ways where they can really appease investors and also protect their business. Taking out this minority investment in Epic Games is certainly one way to do that. It'll be interesting to see if there's other types of partnerships.
But just real quick, again, gaming kids in the household who sometimes play Fortnite, apparently Disney characters are going to be in Fortnite for people to have as their avatars.
And if you think about Bob Iger's relationship with Apple, could this be a play for the Vision Pro down the line? I don't know when you think about gaming. So this definitely caught my eye. Also the fact that they are releasing full year fiscal 2024 earnings of $4.60 a share. That's an increase of at least 20% versus 2023. They haven't done this in quite some time, but they're trying to, again, reiterate to shareholders, we know what we're doing. We have a handle on this business, and a part of that comes with that 50% boost to the cash dividend, that $3 billion share repurchasing agreement. So lots is happening at this company. And I think the earnings call is going to be really exciting. That takes place in about 15 minutes because who knows what else could come out of this. And I'm sure there's going to be a lot of questions when it comes to the sports partnership with Warner Brothers Discovery along with Fox. Maybe we'll hear some more color when it comes to the ESPN standalone service. So a lot of moving parts to this business, but clearly the way the stock is reacting right now, it's positive for shareholders.
It is positive, although it wasn't all amazing, we should mention, right? Subscribers did miss estimates.
Yes.
And so it feels like, this is a situation where Disney is saying, that might be negative, but here's some cash back and here's some other exciting things that we're working on.
Yeah, and they did guide to subscribers ticking up between 5 to 6 million in the second quarter. They did say that they expected those core Disney Plus users to come down amid those price hikes that we saw. We saw 2 price hikes in 2023, and whenever that happens, you usually see that increased churn. So I think that positive guidance it's helping offset that a little bit. We also saw revenue come in slightly below expectations there, but adjusted earnings, a pretty significant beat, $1.22 a share versus the estimate of 99 cents. So, so far so good. We'll see what Bob Iger has to say. In the background, we have this proxy battle with Nelson Peltz, which shareholders are very in tune with. So we'll have to wait and hear if he has any updates on that as well.
We will. Ali, thank you so much. Let's keep talking about Disney. It's jumping on those first quarter results and the forecast and the cash return to shareholders and the investment in Epic Games. Let's bring in Geetha Raghunathan, Bloomberg Intelligence Senior Media Analyst. Great to see you, Geetha. So as we look at all of these headlines coming from Disney, I would first ask, what to you is sort of most significant for shareholders?
Hey, Julie, thanks for having me. So I think the first thing is really the cost-cutting measures, whether those are, having the intended effect, and it definitely looks like they are. And I think that, the most important metric in terms of driving future profitability for Disney is really the streaming numbers. And we know that they've been losing a lot of money on their streaming businesses. They lost about $2.5 billion last year. Before that, they lost about $4 billion. But the whole idea has been to kind of really moderate those losses. And we saw some really big improvement there. So just in the same year ago period, they had lost close to almost $1 billion on their streaming business. This quarter, the quarter that they just reported, it was 138 million. So huge strides that they're making in streaming profitability. They're still guiding to hitting, break even or positive profits in the fiscal fourth quarter, but I think they might possibly get there even sooner, just kind of looking at the progress that they've made.
And another headline we were just talking about here, I'd love to get your take, that Disney's going to invest $1.5 billion in Fortnite maker Epic Games. What did you make of that?
Yeah, I mean, I think it's really important for them to kind of have some play in the video gaming space. So, we've heard Netflix time and again when they've kind of addressed talk about competition, the one thing that Reed Hastings would constantly say was, we're not really competing against Disney or, Amazon. We're competing against, number one, sleep, and number two, video game makers like Fortnite, right? Because you look at all these youngsters, they're constantly so deeply engaged in that content. And really what all of these media companies are trying to do now is increase their engagement. They want more and more people spending time on the platform, right? Because that's how you can finally upsell. That's how you can sell more advertising dollars. And that's kind of their final place. I think this is really good. I mean, Disney is a company that has kind of really struggled, I think, in the gaming space, which is why they've only licensed their content. But I think this is really a smart move by them.
Geetha, I'm seeing that Bob Iger, who is speaking on another network, is saying, among the other headlines, he's not planning to speak to Nelson Peltz, the man who is leading the sort of proxy fight and activist battle against Disney. Are these numbers, though, enough to try and satisfy activists who are wanting better things from Disney? Are these the better things?
These are absolutely the better things, Julie. I mean, they just spoke to, 20% EPS growth. Where do you get that in old media right now? I mean, if this doesn't satisfy Nelson Peltz, I don't know what will. Bob Iger obviously has done everything that he can. Yes, he does have more things to do in terms of kind of reinvigorating, the content pipeline. The movies haven't been doing very well. But he is absolutely working when it comes to articulating a new ESPN strategy. We obviously saw that with that new sports bundle. We're seeing some tangible results when it comes to streaming profitability. We know exactly what they're doing, what they're planning to do with their parks. They're investing $60 billion. And I'm not really sure, Nelson Peltz, other than, just adding to the noise, I'm not really sure he has any concrete plan that Bob Iger and his team haven't already kind of thought of and addressed.
Is this actually a positive thing, though? Has it been a positive thing for Disney in that maybe Iger was getting a little complacent and this has spurred him to make these kinds of changes?
Yeah, initially I kind of thought that maybe it was a little bit of a distraction, but kind of seeing what Bob Iger has done in terms of the cost cuts, the $5.5 billion, taking that up to $7.5 billion. He's talking about free cash flow going back to pre-pandemic levels, $8 billion in free cash this year. And then, of course, we're seeing the buyback, the dividend. I think definitely, I think Nelson Peltz has definitely had an indirect role, or maybe even a more, direct role to kind of play in this.
And Geetha, this is the first earnings for new CFO Hugh Johnston. What do you expect to hear from him, Geetha, on the call? You think it's going to be just all about stream profitability and right-sizing costs?
It's going to be really interesting because Hugh Johnston is known to be one of the best communicators, at least when it comes to kind of conveying things to the street. So it's going to be interesting to see whether he is he's going to give more guidance. Disney has typically been fairly conservative, fairly tight-lipped when it comes to kind of making projections. So again, really kind of excited to see what he has to say and whether he really wants to provide the street with, a lot more guidance in terms of what to expect.
Geetha, thank you so much for your insight and time today on all things Disney. We appreciate it.
Thank you.
Meanwhile, PayPal shares, they are falling after just reporting results. Let's get those to you right now. It's kind of mixed here, Julie. Q4 adjusted EPS 148. That clocks in. That is a beat, right? Consensus was closer to 136. Q4 revenue 8.03 billion. That's also a beat. You're looking at Q4 total payment volume 409.8 billion. That was greater than expected, but a little concern here perhaps about that 2024 adjusted EPS guidance. That comes in at 510. That's light, at least relative to expectations. Street was a little bit closer to 549.
It seems like everything in terms of the forward-looking forecast is below what analysts had been estimating here. So you were talking about the adjusted earnings per share forecast for the full year. Free cash flow for PayPal for the full year, it says will be $5 billion. Analysts were predicting more than $6 billion here. The company also says for the full year it expects to repurchase at least $5 billion worth of its shares, but that does not seem to be necessarily stemming the downdraft, at least not for now, when you see that 6% decline. So I think we got to look at, looks of the call, see exactly what is going on the forecast side and why that's short, especially when the company's fourth quarter numbers beat. So what's going to change in terms of momentum as the year goes on? It's going to be an important question on the call for PayPal.
Yeah, you'll have questions about, the core checkout business, competition there from big rivals like Apple and Google. You also have a relatively still new CEO at the company right now who's been trying to get leaner and meaner. Of course, the layoffs, introduce some new initiatives, which didn't exactly wow investors, at least initially, but certainly a lot of questions to go through.
A lot of questions, and we're going to talk more about it coming up after the break. In fact, we're going to take a deeper dive into PayPal's latest earnings and that forecast with an analyst on the other side. So stay tuned. We'll be right back.
PayPal shares slightly lower here after the company reported fourth quarter earnings, though it beat on revenue and the bottom line in its latest quarter. Company's full year profit forecast falling below consensus. Here with us to discuss is Moshe Katri, Wedbush Securities Managing Director, Equity Research. Moshe, it's good as always to see you. Let me just get your take on the print here, Moshe. What do you make of it? The stock is sliding here a bit in the after hours, though we're off the low.
I would say that the quarter was probably a bit better than feared. They beat on revenues, EPS, volumes TPV looks better. Take rates and operating margins, which have been both kind of areas of concern, did better than expected. Guidance seems to be pretty conservative. Q1 seems to be impacted by FX. For the year, we'll have to kind of wait and see what's kind of driving the lower than expected guide. The narrative here continues to be what's PayPal doing on a competitive landscape and how are they faring versus people like Apple Pay. And then you have the other issue that they have to deal with, which is the volume mix. Volume mix has impacted take rates in the past few quarters. And at this point, I think, the change in the narrative, I think any investor base needs to see what the new CEO plans to do. How do you offset the volume mix issue and what sort of innovations the company plans to kind of focus on in order for their competitive position to kind of change here?
And Moshe, on that front, there was some disappointment around the announcements that the company recently made, perhaps because it built them up quite a bit before it made them. So if that's not it, or was there anything in those announcements that you did think was a positive step, and what more on that front is needed?
I think it's a show me story. It's more than just coming out and saying, that's what I'm going to do. I think people want to see this reflected in the margins and take rates. They waited for a couple of years and it hasn't happened. I think at this point, there's a fair amount of skepticism out there that this new management team can get to that change. The good news is that you are seeing a very, very sticky merchant kind of platform at PayPal, 30 million plus merchants. They love the product. The PayPal button has probably the highest conversion rates. That's a big deal. So merchants are sticking with it. The challenge here for this management team is to build up that ecosystem of products and services to cross-sell into that merchant base. And I think the new CEO will be focusing, given his background, more on the SMB part of the business, which could be pretty profitable. And then on the consumer side, I believe they reported 426 million active consumers. That's down about 1 million from the last time they reported it. But again, here, this is a very robust consumer banking kind of platform, and they have to build that too. So it's all about monetization, and I think the market wants to see results before they kind of buy into this.
And Moshe, correct me if I'm wrong, but you have an outperform on this name, so equivalent of a buy. What are the catalysts ahead, Moshe, specifically that you see that make you bullish on it?
We like the financials. The company has almost $12 billion worth of cash and short-term financial instruments on the balance sheet. They're going to make about $5 billion in free cash flows this year. Stock's trading at 12, 13 times. This is not a structural issue problem. This is an execution issue. And if you're able to execute better, I think there's a lot of upside here in terms of earnings power.
All right, well, we'll see if that plays out. I'm really interested to listen to the call later, Moshe, and I'll be interested to read your note on that call as well. Thanks so much.
Thanks. Thank you.
Take care. Shares of New York Community Bank Corp creeping back up today after naming a new chairman. This coming after Moody's downgraded the bank's credit rating to junk late Tuesday. The recent sell-off of NYCB shares has investors wary of the regional sector's health. Joining us now, David Smith, Autonomous Research U.S. Banks Analyst, and Janney Montgomery Scott, Director of Research, Christopher Marinac. Thank you guys so much for joining us. There was also a report today that NYCB was in talks to perhaps try to sell some of its mortgage portfolio and or its RV and marine portfolio. David, I'll start with you. How much is that going to help if, in fact, they succeed in doing that?
Well, it's hard to know until we get more details on exactly the size of the portfolios in question and how those loans are marked on NYCB's books today. Certainly, shrinking the balance sheet could help from a liquidity and capital perspective, but ultimately NYCB needs to, balance efforts to right-size its balance sheet with avoiding having to take losses by selling loans where there are credit concerns or, under market interest rates. So still a little early to tell the ultimate impact these actions could have.
And Chris, I want to bring you in here as well. And one thing I thought, viewers might benefit from, Chris, is, when we talk about NYCB, I bet a lot of viewers, they hear the word regional, and so they just instantly think small, pint size, nothing to see here. But this is a fairly, sizable lender, right?
Oh, sure. They're a $116 billion balance sheet. They're a real player, particularly in the multifamily marketplace, the mortgage marketplace. They do a fair amount of C&I lending. The company is going through a business model change that was happening anyways before this episode, and they're a real player. And I think what you want to see them do is really diversify their book. As David was saying, it would be healthy to take low margin loans and put them into higher margin loans. I think that will happen. The question is timing, because none of this can happen fast enough for investors that are worried about the stock.
And Chris, to be clear as well, I mean, we were looking at a situation last spring where banks went out of business or were sold to other banks because it looked like they were going out of business. And I would ask you first, Chris, and then you, Dave. Is that something that is a concern in this particular case?
Not for me. I think the company is a going concern and will do quite well. I think this is an episode where there's been a loss of confidence because of the way that the earnings were communicated and simply the level of surprise about the dividend cut last week, and sort of the surprise that the regulators have clearly been engaged here to kind of push them for change. I think they were seen to be kind of a very untouchable company because they won the FDIC deal for Signature. But there's a transition where the company has now joined the big leagues of the big national banks, and they have to perform the same on both liquidity and risk management. It's just a transition that has happened faster than folks realize. The capital rules are still changing within the Fed this year. They're not 100% done, but the banks are expected to be compliant pretty quickly. And I think some of this is NYCB wanting to get ahead of it and be very proactive. But it's painful to cut the dividend and painful to take all of this credit change right away. We certainly would have wished it could have happened in a different light to kind of prepare the market instead of shock it last week.
And Dave?
Yeah, I'd agree with Chris broadly. I think these issues are, contained at NYCB. These are issues, pretty idiosyncratic to the bank with its transition from being a smaller regional bank into a larger one that's under stricter regulatory supervision at this point. I think, when you compare NYCB to, the banks that failed last year, it screens much better from a deposit standpoint, much higher share of insured deposits, lower interest rate marks on its balance sheet. So, there are certainly questions about its earnings power in the medium term and, potential, credit issues in its multifamily book. But, I think this is an issue of earnings rather than of viability, certainly.
And Chris, I'm just interested to get your take on whether you were surprised that maybe regulators weren't more on top of NYCB, just given, as Julie just noted, it was only about a year ago that we were dealing with Silicon Valley Bank.
So good question. I think the regulators were embarrassed by what happened with Silicon Valley, First Republic, and Signature. That's on the FDIC. I think the OCC, who is now taking over, has a freshly minted client in NYCB and basically are saying, we're not having this happen on our watch. And we're going to manage this bank very carefully to make sure that they transition to the new world order. I think we're all guilty, myself included, that the company's stress test in 2024 in June really had to start happening now, and that there were changes that had to happen December 31st and here in the first quarter for the company to be prepared for that. That's part of them raising their reserve to peer. I think the main move in criticized loans, whether it's multifamily or office, had a lot to do with stress testing those loans, taking a borrower adding 200 basis points and making sure that the cash flow debt service coverage was strong. And that's a lot of the reason why there were downgrades of loans from pass to non-pass and then reserves established. I don't think those loans are ultimately going bad. They're just going to struggle under a higher rate environment. But we may see the opposite. Rates may go back down and we may see a little bit of light at the end of the tunnel for them to refinance. It's more of a timing issue than anything else.
Dave, Chris, thank you both so much for joining the show today, helping us kind of make sense of this story. And something tells me we're going to keep talking about it. Appreciate it so much.
Thank you.
Thank you.
And coming up, we're checking in on some of today's top trending stories. Disney announcing it will launch a new standalone ESPN product as part of its earnings, and it comes on the heels of the new sports streaming service announcement yesterday. But will consumers want to pay the price? Stay tuned. More Yahoo Finance on the other side.
Welcome to Yahoo Finance's group chat. I'm Josh Schaefer alongside Subramanian and Dan Howley. And today we are starting with a major play in the sports streaming space. ESPN, Fox, and Warner Brothers Discovery are bringing together a slew of sports networks under one app. The official subscription cost for this new app, which hasn't been named, has not been listed, but CNBC out reporting today that it will have a price tag starting at or potentially more than $40 per month. Should also note, guys, some other news out of Disney as they're reporting earnings just now in the last hour. The ESPN standalone streaming service that we've been waiting for is slated to launch in the fall of 2025. So that could, in some ways, be a different option here. If you just wanted sports that are on ESPN, you wouldn't have to go for this full bundle. But the bundle and the reported $40 is sort of what I want to bring to the table here and debate. $40 to get a slew of sports leagues, right? We're talking exposure to NBA, exposure to MLB, a decent amount of NFL games, pretty much all of the NHL games. So you're going to get a lot of sports, but $40 a month is a pretty big price tag.
Do you want to rant or do you want me to rant?
I'll do my quick rant real quick.
Go for it.
Seems like a helpful service, but I have cable. Like, I don't understand why we've disintermediated all this into like multiple streaming services. Then they all kind of come back together Frankenstein-like, and I got to pay money for this. But then, I don't get Comcast, I don't get whatever else, one of the big major ones, CBS, right?
Yeah. So you're missing the NBC and CBS football games. As a sports fan, that's the biggest thing I take away from this.
So
it's Sunday Night Football and then the CBS games on Sunday.
It's not perfect, and then for $40, how much would it cost for ESPN, all the Warner Brothers content, and then the other one, which is whatever, I can't remember now. Fox.
Yep.
Like, would that have been $40 for the entire, month? I probably, I don't know, but it seems like, what's going on here?
It's to me, it's the dumbest thing on earth. I think that all these companies are just consumer hostile. I think that, look, I pay, I think it's $80 a month now for YouTube TV, right? I got to get my Naked and Afraid. I got to get my Bar Rescue. I got it specifically so I could watch the Mets originally, right? Because I didn't want to pay for cable. It was too expensive. And so I was like, okay, I can watch the Mets lose with YouTube TV.
Sure.
Great. Now it doesn't have the Mets because
it's local, right? Or MSG?
And all these companies just hate consumers, I guess. Yeah. But now I would have to pay, $40. If I pay $40, do I get SNY? No,
SNY,
right?
So my defense is, I'll Gen Z-ify this a little bit because it's targeted for my generation. I think a younger generation that by the time I graduated, college, I never got a cable package, right? And so Disney directly said that they're basically targeting me in this.
Yeah.
Right. And I'm a buyer. I'm a buyer at $40 because I don't have cable. This gets me most of it. Tack on Paramount Plus for like $6 or whatever it is, and Peacock, and I'm still below $55, and I get all the NFL games I want. And really, I only watch sports, and then I'd probably get Netflix with ads, and I'm under $80, and that's all the TV I need.
So Lachlan Murdoch did say, Fox chairman or whatever, said that this is for the cord nevers, and that's not you.
I'm a cord never.
Yeah, you're a cord never. We're cord guys, right? So
I'm just going to end with this. When I had cable and I was getting the Mets, I would pay for cable, internet, and it was cheaper than all the stuff that I have now. But speaking of bundling, the market for AI PCs and smartphones is expected to jump over the next few years. Gartner predicts more than 40% of all PCs in 2025 will come with built-in AI. And the real question is, do we really need it? Now, let me just throw this out there. AI PCs are PCs that come with what are known as NPUs, neural processing units. Just a little piece that's included in the CPU, which is your central processing unit. AI smartphones, same exact deal. AI smartphones kind of make sense. You already use a lot of AI in your smartphone. Saw it with Google's Pixel Pro, the Pixel 8 Pro, and the Pixel 8. Samsung now has it. You can do some fun little things with your photos, right? Change it away. I can make it look like I'm slam dunking. Never happened or will happen. But I think that the big thing is here, these are premium products.
Yeah.
And if you talk to Intel, you talk to AMD, you talk to Qualcomm, these are the ones making the chips. They don't know why they're out there. They're like, we'll make it. But my parents want one. Why?
Yeah, this sounds like when you go to the Apple store and there's two different MacBooks and one is $100 more, and the expert person just tells you it's a better chip and it runs quicker. And I just kind of listen to them because I'm like, well, I want the fastest computer.
Right.
And you just do it and you pay up, and we'll all end up paying up for this as consumers without really understanding what we're getting. Like, I think I'm probably gonna buy it, and I still won't necessarily get what I'm buying.
maybe there's a bit of future proofing there for, you might say, I might need some AI application in the future. But Holly, I don't understand why, like, half of users apparently have tried Siri, right? Siri works on your phone. It is an AI application. Why can't the AI stuff happen in the cloud on a supercomputer somewhere else? Why does it have to happen locally on my phone?
So that's really the main thrust of the sale right now is you have all this stuff that you're using your phone for, right? There's private things on there, creepy things, some people might say, and definitely not on mine. But you don't want that necessarily going to the cloud, right? You want that to remain private, so the idea is you would be able to do all of this on your device. That's the thrust of it. So you would be able to use something like a ChatGPT or an Adobe kind of image generator on your device, never leaving the cloud. It's going to be faster, never going to the cloud. It's going to be faster, it's going to be more secure. Outside of that, there's no applications that are really taking true advantage of this yet. So it's premium, it's $900 to start for these AI PCs. My parents are on a fixed budget, right? Why do they need to buy that? As you said, future-proofing, sure. The PCs themselves, since they're coming with better processors, they'll last longer. And that's usually what I say to people. Go with a higher end processor than the little bargain basement one, because otherwise you're going to be spending $300 in another year. So get the more expensive one, but in this case, maybe go a little bit lower because, frankly, I don't know what the AI PC point is right now, but that's just me.
Well, it seems like AI is everywhere, doesn't it? So even the Super Bowl, Microsoft released its latest ad highlighting the company's Copilot or AI offerings, which will play during the big game on Sunday. You see right here, it says they say I'll never open my own business. They say they counted me out. They said I couldn't get a degree, or they said I couldn't code. And then it shows the actual Copilot, code this thing, storyboard this movie, et cetera, et cetera. Looks pretty interesting. I mean, it kind of gives you more of an inspirational kind of vibe for AI, but in reality, I think we have a bunch of different takes here. The question is, are we really going to be using this product for these said sort of use cases?
I think it's interesting because it's the broiest commercial I've seen for tech stuff in a while, and I don't think it really tells you exactly what this does. Copilot is a really great product. It comes built in.
Write code for my 3D open world game.
There it is. All right, so
brand new game. It's all on the Xbox store.
Game developers, go get new jobs. I guess. But I just think this is the wrong marketing way to go about this.
Where it loses me is the AI pitch that I understand that sort of why you would use Copilot would be to use it to help you with your current job. Would make a ton of sense, right? Like say you're writing resumes or job applications and you use AI to help you with that and make your job more efficient. And this commercial is like, well, if you never thought you could write a screenplay, you can use AI, which I think is actually maybe more the way people are scared of AI, right? It's like you could take screenwriters' jobs by just using AI to help you, and then all of a sudden you're going to get really good at it.
I didn't see it that way. I saw it more as like an inspirational, I can do these things that are entrepreneurial or on my own. I don't need people to help me out with them. But you're absolutely right. It is sort of a thing where it's like, forget the screenwriter or forget the storyboard artist. He's done. I don't need him anymore.
I just think it's one of those things where Copilot built into Windows is awesome. Eventually you'll be able to control your whole computer by just being like, install printer, and it'll, bam, do it. That's like where they're going, right? Like that's the whole idea for this.
Boom,
that's
done.
Sick, right? Setting up a printer. Fix that, HP and Dell and everybody. It's still a monstrosity, but that's the idea. This doesn't really sell you on how easy it's going to make things, and that's the point of it.
We got to get Dan Howley on the next Microsoft ad. I think that's where Dan gets the AI pitch. He's got to be.
Well, there's a guy with the Vision Pro out here somewhere walking around, so maybe we can just have him do that.
We'll have to go test that out, guys. But coming up, we're going to bring you what to watch tomorrow. We break down the stories you need to know to start your Thursday. But for now, we want to leave you with this shot of our very own Dan Howley earlier in the show.
My God, coming at you.
AI could never recreate it.
No, God, I can only hope.
Let's take a look at what's trending after hours. We start with Wynn Resorts, the casino operator, rising after reporting an earnings beat for the fourth quarter. The rise in net income primarily driven by the increase in operating revenues from Macau and Las Vegas. Operating revenues also topped analyst estimates for the quarter. And I'm looking at Mattel here as well. The company reporting a rise in profits for the fourth quarter, but missing Wall Street estimates. Sales for the quarter also slightly missed estimates. The company is set to launch a new cost savings program focused on profitable growth, as well as expecting to improve profitability and continue share repurchases in 2024. And Mattel, by the way, also coming out with a gross margin forecast for the full year ahead of estimates. Its earnings forecast also leaving it room to beat estimates as well. And finally, Disney, which we talked about earlier, coming out with a slew of announcements on its conference call following its earnings beat in the first quarter. And its forecast as well that was ahead of estimates. The company says it's going to roll out a standalone ESPN streaming platform in fall 2025. It's also going to be the sole streaming home of Taylor Swift Eras Tour. Taylor's version, that's going to be exclusive to Disney Plus starting next month. And later this year, a new animated Moana sequel is going to hit theaters. Disney CEO Bob Iger also saying the company will prioritize dividends and buybacks. You excited for Moana 2? I'm excited. I really liked Moana. I gotta say, it was really good.
I trust your call on that.
Have you not seen it?
I haven't seen it. No, not yet. No.
Oh, you're in for a treat, my friend.
Sounds like a date. I'm there. Yeah. All right, we move on. Time now for what to watch Thursday, February 8th. On the earnings front, Philip Morris, ConocoPhillips, AstraZeneca, Take-Two, and Kellanova, and Pinterest, by the way, all reporting tomorrow. Pinterest will be in focus after we've seen mixed results from social media companies this earnings season. Meta reporting a blowout quarter last week, and while there was hope Snap would follow suit, that was not the case, and the stock plunged. So Wall Street will be watching to see how Pinterest now stacks up against the competition.
Moving over to the Fed, Richmond Fed President Tom Barkin will be speaking again tomorrow. This coming after Boston Fed President Susan Collins said cuts could come, quote, later this year. She is the second Fed official to use later this year language in as many days.
And taking a look at the job market, jobless claims are out ahead of the open, and economists forecasting a slight decrease from the prior week.
All right, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. He's going to have a full Moana review, so you better tune in tomorrow.